perhaps to understand the need for this, this agency is being proposed to be part of an ecosystem of financing Africa's sustenance, self-sufficient. So you have African MDBs, development banks, that are supporting impactful projects and infrastructure financing. So for you to complete this ecosystem and for us to support the flow of capital into Africa, we need opinions, or we need entities that profile these projects for the benefit of investors, not only in Africa, but also outside. Because you have a lot of pension funds that are still taking their funding outside Africa. You have, including our own central banks, that are keeping reserves outside Africa. The sovereign wealth funds, even investment firms that are still keeping money outside Africa because of investors' mandates that they need to keep these investments in A-rated entities. That's the context in which the proposal for having an Africa Credit Rating Agency has been pitched as an institution that will provide alternative opinions to investors who are interested in African instruments. That you have a report on credit risk from S&P, from Fitch, or from Moody's. Look at an alternative opinion and evaluate yourself if the risk perception will remain the same.
Yeah, because it's very important to counter those perception biases that could be at play here. And I'd like you to speak to that, as well as also the conversation around security.
Indeed, it's important to note that in layman's terms, we say financial markets trade opinions. So whoever has a credible opinion at that particular point is the information on the basis at which investors will make a decision. Now, I was mentioning a very important component of financial markets. In Europe, a rating agency is not allowed to make an announcement during the week. It's mandated by law to only issue an opinion on Friday after close of business. Why? Because they don't want investors to make decisions based on one source of information. So it's a very important point that we might not need to entirely depend on outsiders' opinion, especially if it matters to do with African instruments. So that's also the basis for which this proposal was, that we need context-intelligent methodologies that will perhaps provide a broader perspective for investors to digest this information and make decisions.
Yeah, because I would also like to look at it from the other angle about long-term, talking about capacity building, especially on the continent, you know, and why that is also very critical down the line.
Well, I think it's a no-brainer that we need to develop an ecosystem that will capacitate Africa's development. For now, there's a phenomenon that has been going on for some time now. The issue of financing development in Africa, you know, from a fiscal balance, fiscal financing perspective, that we are financing through Eurobonds, which are bonds issued in foreign currencies. And these bonds have been oversubscribed. So in other words, there have been greater demand than bonds that have been issued. So you find in some instances the governments are ending up collecting money that they did not initially anticipated to get. But these bonds are coming at a very huge cost in terms of interest rate. That's why there's a lot of talk about the interest rate burden. So we've been engaging with governments to develop capacity, have people who are skilled in bond pricing, who are skilled in understanding methodologies that are applied by bond issuing syndicates. And this is very, very important capacity to have, because it saves you a lot of interest that you are necessarily paying to outside ecosystem of investors.
Yeah.
So you rather pay this money to a skilled person to reduce this interest through negotiating for a better pricing in these bonds, rather than just being a price taker on the international market.
I'd love to bring up one other conversation that came out here today in the conversations earlier with Professor Jeffrey Sachs, where they mentioned the conversation around debt, around ceilings came on, rating ceilings came up, and I'd love you to address that, especially looking at how the private sector and the sovereigns and shouldn't be looked at in the same manner. I would love to get your opinion on that.
Well, unfortunately, it's the existing rules of the game.
Yeah.
What is called a sovereign ceiling.
Yeah.
So in other words, this thing, mind you, it's also affecting our own multilateral banks. I was interacting with the report for Afreximbank recently. There is a component which they call average status of key shareholders.
Yeah.
So in other words, it's very difficult for Afreximbank to be where it is now in terms of rating, because most of its key shareholders are rated below investment grade. So a sovereign ceiling, the assumption is that you are not able to operate an outstandingly competent entity when you are in a jurisdiction which is constrained. So in other words, if your sovereign is rated at B, the assumption is it's very difficult to have an entity within that territory that can pierce through the sovereign ceiling rating to be rated investment grade, which is a very unreasonable assumption, actually, because we have very, very competent entities that have very strong balance sheets and are highly collateralized, very capitalized, strongly capitalized, and with very strong shareholders, that if they are brought into the radar of correct ratings, they should be able to get a much more stronger exposure than they could. But you find that one of the interesting issues is that they are not even able to afford the cost of rating, to maintain a rating, because it's very costly to get that from the big three international rating agencies. I'll cite a very recent case close to home that Dangote Refinery actually had to withdraw its rating with Fish because it was not commercially viable, and also they did not want, or they did not need to use the rating to raise international capital.
So that contextual relevance is very key if we're going to move forward in these conversations. But as we wrap up today, a lot has been said in the past 3 days. For you, what has been the biggest takeaway?
Well, I think the message has been very consistent. They need to reconfigure African financing on the basis that it's no longer an assumption that international capital is retreating, either in the form of concessionary financing or the traditional partners. They've retreat, and we need to reconfigure how we can finance Africa sustainably. And I'm very optimistic from the message that has been circulating here. From all the panelists, we're converging on the sense that Africa needs to be self-sustainable. And that can happen if we strengthen our own African institution, give them the support, including the issue of the preferred creditor status, which has recently been questioned by the likes of JP Morgan and the IMF economists, that we need to, or member states need to revoke the preferred creditor status, which is a self-defeating request, because once that is lifted, we are compromising the capacity of this institution, their ability to raise money, and their ability to meet the mandate of supporting development in Africa.